Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today we're going to be analyzing Hilton Worldwide stock, the hotel company. This request came in by request down in the comments of one of my other videos. If you have a request you'd like me to take a look at, just drop it in the comments. I'll get the ticker on the whiteboard behind me. I finished up one column the other day, and I'm working on another one. And I'll eventually make a video for you. If it's a stock that's in the S&P 500 like Hilton is, I'll post those on YouTube for free, and the rest I'll post over on Patreon. There's a free tier over on Patreon where I'm starting to post some new videos on books and things that I'm reading that I'm not currently posting those on YouTube yet. And then at the $5 tier level, you can request those tickers that are not in the S&P 500, and I'll post those over on Patreon. And you also can get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha if you join on Patreon. So I'll have all those links down in the description. I'll also have a 25% off link to Fast Graphs, which is the graphing service that I use in a lot of my videos here. That's an affiliate link that will be down in the description as well if you've never tried Fast Graphs before. As always, this is not individual investing advice. This is just how I analyze stocks. And today we're going to look at Hilton. So back during the Great Recession, if anybody ever wondered how I ended up doing such an unusual job, I take people, I'll tell people sometimes, what I do because they'll ask. And most people, I live in the Midwest, and it's not like you live in New York where there's a lot of people that work in finance. And the how I ended up doing this, and they're always surprised because most people don't even know anybody that does anything like stock analysis or anything. So I was a stay-at-home dad for a long time. I still am a stay-at-home dad. I'm still homeschooling one of my kids for one more year, I think, and then maybe I will be free of that responsibility someday. But my first child was born in 2009, and I decided to stay home and work just kind of part-time. And one of the few jobs that was available that paid halfway decent for a part-time stay-at-home person who wasn't available during the week was at a Hilton hotel. So I worked for Hilton for on the weekends for several years, starting in 2009 during the Great Recession, which is worse than the pandemic almost. I didn't work there during the pandemic. I quit in 2017 before I started doing this full time. But that's what I did in between when I had two little babies at home, and before I started doing this full time. And I did this part time starting in 2015 after graduate school too. But anyway. So Hilton, I liked working for Hilton. I think they're a great company. And I've actually owned Hilton stock before, more as a M&A play, really a split play. You see, in 2016, they had these stock splits. They divided their business into three businesses. Now, there would be more data on Hilton, but they were taken private. I could be wrong. I want to say it was KKR maybe. I forget exactly who. And then they came back public again. So obviously Hilton's been around the business has been around for a long time, but it's only been more recently public. So we do miss data from the Great Recession and things like that, which I don't know. Maybe we have Marriott as their closest comp, I think. And I don't remember if I used, so Marriott does have data back then. And it's going to probably be similar. So the stock price fell a lot. Earnings fell a couple years in a row. Pretty economically sensitive. I can tell you from working at the hotel in 2009, it was a very business-oriented business there at the particular hotel I was working at. So a lot of business travelers and events and things like that. And it was very quiet for a few years there. And by the time I left, 7 years later, it was very busy. My job got much busier over those years. So it's definitely a cyclical business, but not super cyclical, right? It would take you kind of have to ignore COVID because people weren't allowed to travel. But Economically sensitive, but maybe not like super duper deeply cyclical business is how I describe it. Really high quality. And I owned it here because they were splitting off, what was it, like the vacation resorts, which I think is like timeshares maybe. And then I think they're splitting off another like REIT, which was a great move. And I was basically just kind of playing that add in value from the split. So I forget exactly when I sold it. I didn't, but it was during this little uptrend here, and I sold it before, like 2018, I think. And then COVID hit, and I kind of just laid off all this type of stuff. The stock price recovered very quickly, way before earnings did. So there was not really a chance of me being able to get back in it, because it rallied so hard and so quick out of COVID. So I like this business. It is cyclical, but with this data here, we just kind of have to make it. I'm kind of talking about all this because we're just going to have to make things up. We're not going to be able to go back and look at the historical data. We can look at the drawdown data in Marriott, I think, and I use that as a proxy for Hilton since we don't have the Great Recession data. That's probably what I did. I didn't leave a note in my spreadsheet for that, but that's probably, knowing myself enough, that's probably what I did when I calculated it. And so we look forward here. It's had a really great run this past year. Not even year. Like 6 months, it's up like 30-something%. So the main thing to look at here is we do see the general trend is up and to the right. Earnings growth is growing. Expected to grow about mid-teens here. So I was using a 10% growth expectation, but I'm going to use 15% in this analysis, just because that's where the market's currently expecting these earnings growth to come out. And if there is a recession, I have a different way. They won't grow that fast. That will reverse if we get a recession, and that will probably dramatically affect it because it's trading at a 30 PE. It's very expensive, even using these generous kind of expectations. So I'll have a recession metric that we can use too. And that's kind of the setup. We're going to assume 15% growth. I would say, just generally speaking, there are structural advantages to these big to what do we have? I don't know if Hyatt's still on their own or not, or if they merged or something. But we have Hilton and Marriott, and the loyalty programs are really important to these guys, just like the airlines, miles and things. And you connect all those together, and it does create loyalty, and they've really expanded their brands from, I mean, when you used to think Hilton, you just had like the big, Hilton, right? And you still have those. Those are usually downtown a lot of times, or they're a resort in kind of more metropolitan areas, just the bigger downtown areas. But when you get out, and they're usually a little more upscale, but they have all sorts of other brands like DoubleTree, Hilton Garden Inn. What are the other ones? Embassy Suites. And Hampton Inn is a huge one, so you'll find Hampton Inns everywhere. And then now they've launched the kind of lower end or extended stay travel places like Home2. I stayed at one of those in Florida the last time we were there, and it worked pretty well for a small family, and it was pretty inexpensive relative to everything else around Miami anyway. And True, I don't know if I've stayed at a True. I think I did maybe on this last trip, in Vicksburg, maybe, I want to say, Mississippi. I don't know. I've done a lot of traveling, and I've checked out most of their brands because I'm a member of like the loyalty program. And so these loyalty programs do really work. I can tell if I'm working at Hilton and using it. And same goes for like Marriott's rewards or whatever. And you can combine them with the hotel points. And the thing is, like, for people, if you take like a family, if you use like a few of these credit cards or whatever, you can usually build up enough points after a couple of years to take almost like a full family vacation with your airline points and your hotel points. And it can really discount a family trip. I mean, I used some of these in Hawaii the last time when we were there a couple of years ago, And a lot of times nowadays, if I fly into a place with the family, or we have to stay downtown or something like that to catch a plane, or arriving late, then I'll use the points to stay in whatever the metro area is before we go on to do whatever we're going to do. And that's kind of nice. So, general thoughts on the whole Hilton thing. Now let's get into like the actual numbers. So if we assume the 15% earnings growth, which I think is, I had 10% in here, but people give me a hard enough time about my buy prices anyway, and I hadn't updated it for a couple months. So if everything goes really well and they do grow earnings at 15%, this is what we'll look at. That gets the current PE at like 28 or so. And let's see. So earnings yield of 2.82%. So if you bought Hilton for $100, you could expect it to pay you back $2.82 in earnings the first year. And if those earnings grow at 15% a year, what I want to know is how much in earnings for my $100 would I earn over 10 years. I pull the first year forward, so you actually earn $3.24 the first year. So when I run those numbers, I end up with earning about $66 on my 100. So you start with 100, you end with 165.80, and after 10 years. And if you put that in a CAGR calculator, you come out to a little over 5% CAGR. So that's pretty richly. I mean, it's not too far away from the market, but assuming this 15% earnings growth rate is like as generous as I think you can probably be, and it's still a little bit more overvalued than the market. Now, it's not less than 5%, which is usually where I would consider selling it, but it's right. You know, this is one where if a person had a big position, like trimming here would probably be a decent idea, just based on valuation. But structurally, you know, I like the business. Now, the problem is if there is a recession, even if it's moderate recession, they'll get hit pretty hard. So typically, if I'm going to buy using these assumptions, if the 10-year CAGR is 8% or higher, which means the price goes down, the CAGR goes up, all else being equal. 8% is kind of the threshold I want. It would hit that at about $117. So that's about 43% lower. And then if we have a recession, again, those earnings are going to fall instead of, and when you go from expecting to rise 15% a year to like falling 15 or 20% a year, the stock price will plummet. So this might look like a super low buy price, but if we have a recession, like a normal recession, it wouldn't surprise me at all if, you know, this is at least a reasonable place to buy, somewhere between 117 and 185. So that's under 86, not 186. Under 86 is about 58% lower than we are now. That would be my buy price with a margin of safety during a recession. And then the rest of the time, if it's not a recession, if we just if there's external reasons why the stock falls and the earnings keep coming in pretty decent, then that 117. So it's a great company, good business. Almost, it's not really a duopoly, but you know, in terms of stocks you can buy in the market, Hilton and Marriott are it. That I think are similar quality. And there are other hotel chains, but I think these are the two that are kind of doing everything right. And you could hold them for the long term too if you got them at a good price. So, but right now it just looks to be, we're in a travel boom, and I don't know how it could last quite a while. Older retirees there's a big chunk of people that have recently retired and the stock market's done well and they have money and they want to spend it and they want to travel now, and they're traveling like crazy, and you know, these are the type of hotels that they can afford and consistently get good service at. So those 15% growth rates might really happen for the next few years. But 10 year doing it for 10 more years uninterrupted will probably be hard. So I think eventually there'll be an opportunity probably to buy this stock, but at a cheaper valuation. But it's really hard to say. But to me, to pay a 30 PE for a business like this that's economically sensitive during a pretty big upcycle is just a little too expensive to consider buying right here. In fact, I would probably trim, and even trimming here, and if you wanted to add back when it got down closer to like that $25 or 25 PE ish seems more reasonable to me. But all right, so those are my thoughts on Hilton. If you found this useful, hit the subscribe button, hit the like button. If you have a request, put it down in the comments. I'll get it on the list of stocks to cover, and I'll eventually make a video later.